The average age of the first-time homebuyer in America is now 40 years old. 40. That means the typical American buying their first home right now is closer to getting Social Security than they were to being the age of 18 and graduating high school. Think about that for a second. By the time you're able to afford a home, you're closer to retirement than you are starting adulthood. That's not a housing market. That's a generational wealth transfer failing to play out in real time. And nobody's talking about what this really means. In today's video, I'm going to break down the data and give you the hard truths about the affordability of the housing market. I'm Brandon. I've interviewed over 200 of the brightest minds in economics and markets. If you actually want to know what's going on, be sure to subscribe right now. Let's dive into the data, because when you look into the numbers, it's worse than the headlines suggest. The National Association of Home Builders just released their 2025 price data analysis. Here's what they found. 75% of American households cannot afford a median price new home. That's 100.6 million households out of 134 million total, who are mathematically locked out of buying the middle home. Not a nice home, not a big home, the median, the 50th percentile. To buy that medium new home at $460,000, you need to earn at least $141,000 a year. That's the minimum qualifying income at today's rate. The median household income in America is $104,000. There's your gap, a $37,000 income gap just to qualify for the average home in this country. And here's the thing, even if you do qualify, even if you make that $141,000, you're still spending about 36% of your gross income on your mortgage payment. HUD or HUD says you should spend no more than 28%. We blew past that threshold years ago. But wait, it gets worse. The home price to income ratio just hit 5 nationally. That means the median home cost 5 times the median annual income. For context, in the 1990s, that ratio was 3.2. In 1985, it was 3.5. A home costing 3.5 times your annual income, that was normal. That was the American dream. Math that actually worked. We are now at levels that match or exceed the 2006 housing bubble peak. And in 78 of the top 100 metro areas, home price to income ratios are at all-time highs. Harvard's Joint Center for Housing Studies tracks every major metro area in the country, and the data shows that in 2000, two-thirds of large markets had price to income ratios below 3.0. That was normal. That was healthy. You could reasonably expect to save for a few years, put 20% down and buy a home. Today, only 3 markets in the entire country have ratios below 3.0. 3 out of 100. Toledo, Akron, and McAllen. That's it. San Jose is a 12-1, a home that costs 12 times the median income. LA is nearly 11-1. San Francisco is over 10-1. Miami is 8-1. New York, 7.3-1. And Boston is 6.6-1. Even markets in the Midwest that used to be affordable investments, Madison, Milwaukee, Chicago, they're all above 4-1. The escape valves are closing. And here's what's driving this. From 2019 to 2024, median home prices rose 48%. Incomes only rose 22%. Prices grew at more than double the rate of income. That's not a sustainable trajectory. That's a wealth extraction machine. Let's talk about what this means for monthly payments, because this is where reality hits hard. The median monthly mortgage payment has doubled in 4 years. In 2020, the typical mortgage payment was around $1,100 a month. By 2024, that same payment is now $2,225, more than doubled. The Mortgage Banker Association tracks this in real time, and as of early 2025, the national median mortgage payment for purchase applicants was $2,205. For new construction, $2,531. And here's what's wild. The Census Bureau just reported that home buyers who moved in 2024 are paying $648 more per month than people who bought just 5 years earlier. That's 41% gap, the largest spread between recent buyers and existing homeowners since they started tracking this data. Think about what that means in real terms. 2 neighbors, same street, same model house, one bought in 2020, one bought in 2024. The 2020 buyer is paying $1,500 a month, where the 2024 buyer is paying $2,200 a month. The same house with like a $700 difference. every single month for 30 years. That's $233,000 over the life of the loan for the same house. So you have this two-tier market emerging. People who bought before 2022 that are sitting on 3% mortgages with manageable payments. People trying to buy today, they're looking at 7% rates and payments that consume 40% of their income for the same house. This is the lock-in effect everyone keeps talking about, and the numbers are staggering. Bankrate just surveyed homeowners on their willingness to sell. The results will tell you everything you need to know about this market and why it's frozen. 54% of homeowners said there is no mortgage rate, none, that would make them comfortable to sell their home this year, up 12 percentage points from last year. More than half of homeowners have completely checked out of the market. Only 3% of homeowners said they'd be comfortable selling if rates are 6% or higher. 3%, that's it. And here's the kicker. Among homeowners with sub 3% mortgages, 41% said they would never consider buying again at any rate. Not 5%, not 4%, at any rate. They're locked in for life. These people are never selling. They're not moving. They're sitting on the lowest mortgage rates in American history, and they're never giving them up. So let's do the math on why. So you bought a $400,000 house in 2021 with a 3% mortgage. Your principal and interest payments are around $1,350 a month. Now you want to sell. Your house is worth $500,000. Great. You made $100,000 in equity, but you need to buy another house at 7% rates. That same $500,000 house costs you $2,660 a month in principal and interest, nearly double. You'd be gaining $100,000 in cash and committing to an extra $1,300 a month in payments. That's $15,600 per year for 30 years. That's nearly $500,000 over the life of the loan. Why would anyone do that? You wouldn't. So people don't. They stay put. The data confirms it. More than half of homeowners with government-backed mortgages have rates at or below 3.5%. The average rate on existing mortgages is 4.3%, but the current rate for new buyers, 6.8 to 7. Only 2.8% of homes in America have turned over to a new owner in 2025. That's the lowest turnover rate in decades. Spring 2025 sales volume is tracking at levels last seen during the 2009 housing crash. The market isn't just slow, it's frozen solid. And here's what most people don't even factor in. The mortgage payment is just the beginning. Let's talk about homeowners insurance, because what's happening there is borderline criminal. The Consumer Federation of America just released a report showing that homeowners insurance premiums have jumped 24% over the past 3 years, twice the rate of inflation, or at least alleged inflation. The average homeowner is now paying $3,303 per year for insurance. That's up $650 from 2021. In 2024 alone, the national average increased by 10.4%. That was on top of the 12.7% the year before. 33 states have double-digit rate increases. Nebraska saw a 22.7% increase. Montana, Iowa, Minnesota, Utah, Washington, all above 20%. And it's not slowing down. Insurify projects another 8% increase in 2025. Some states are getting crushed. Louisiana is projected to see a 27% increase. California, 21%. Florida homeowners are now paying an average of $14,140 per year for insurance. That's $1,178 per month just for insurance. In some parts of Florida, it's $2,200 per month. There are homeowners in this country paying more for insurance than they pay for the mortgage and principal interest combined. And then there's property taxes. CoreLogic reports property taxes have risen 27% since 2019. The average property tax bill on a single family home hit $4,271 in 2024, up 5.8% from the prior year. In New Jersey, the average property tax bill is $9,767. Add it all up. Mortgage payment, insurance, property taxes, the average homeowner who bought in 2021 is paying nearly 69% more on their total housing cost 3 years later at the 2024 renewal. That's not inflation. That's a fundamental repricing of what it costs to own a home in America. Bankrate estimates the average homeowner is now spending nearly $16,000 per year on expenses beyond their mortgage payment, insurance, taxes, maintenance, repairs. That's $1,300 a month before you can even count the mortgage. Some borrowers are now reporting that the insurance and taxes consume over half of their monthly mortgage payment. The escrow has become larger than the principal and interest. This is the part that nobody talks about. Everyone's focused on the sticker price and the mortgage rate, but the total cost of home ownership has exploded and it keeps climbing every single year. Let's talk about who's actually being affected here. And it's not just the rich people who are trying to buy luxurious mansions. First-time homebuyers now only make up 21% of homebuyers. That's the lowest share ever recorded. In a healthy market, first-time homebuyers are generally between 35 and 40%. We're at 21. Only 25% of homebuyers have children under the age of 18. Another all-time low. Families are being priced out of family homes. And here's the stat that should terrify everyone. Only 33.9% of renters think that they will ever own a home. That's according to the New York's Fed survey. It's the lowest reading in the entire decade since they've been asking this question. The American dream is dying, and it's in the data. In 79% of counties analyzed by Adam, housing costs now exceed 28% of median wages, making homeownership unaffordable by standard lending guidelines. And in over 1/3 of counties, 199 of them, costs exceed 43% of typical wages, which Adam calls seriously unaffordable. 99% of counties in America now have an affordability below their historical averages. 99%. That's not a regional problem, that's a national crisis. And all of this is creating a wealth gap that's becoming permanent. The typical homeowner now has a net worth of $430,000. The typical renter, $10,000. That's a 43-to-1 wealth gap. 43 times. The gap has never been wider. The Aspen Institute broke this down. Homeowners don't just have more home equity, they own more of everything. Nearly 80% of homeowners own appreciating assets beyond their home. Stocks, retirement accounts, business equity, other real estate. Only 48% of renters own any of those. Homeownership isn't just having a place to live. It's a primary wealth building mechanism in America. And when you price the entire generation out of this mechanism, you create a permanent underclass. Here's the math. If you bought a median home in 2019 and sold it today, you'd have roughly $200,000 in equity gains just from sitting there. That's more than many Americans will save in a lifetime. If you've been renting the whole time, you've been paying someone else's mortgage, building someone else's equity, watching prices climb further out of reach every year, and it compounds. Homeowners have lower debt to income ratios, more positive cash flow, better credit. They qualify for more loans. They can leverage equity for investments, business, education. The gap widens every year. This is why housing affordability isn't just an economic story. It's a story about what kind of society we're becoming. Now, here's where I take this in a different direction, because everybody keeps comparing today's market to 2008. Wrong comparison. Compare it to the 1970s. In the 1970s, America experienced something called stagflation. It's stagnation plus inflation. You get the worst of both worlds. Prices rising while economic growth stalls. High inflation, high unemployment, and a frozen economy. It shouldn't happen according to traditional economics. That's what made it so terrifying. Normally, when growth stalls, demand falls, and prices stabilize or drop. But during stagflation, the relationship breaks. Costs keep rising even as the economy sputters. The 1970s stagflation was triggered by oil shocks. OPEC embargoed the United States in 1973. Oil prices tripled and inflation exploded. The Fed tried to fight it with rate hikes, but the rate hikes crushed growth. So they backed off and inflation would surge again. They were caught in a loop. By 1974, and again in 1979 and 1980, inflation was running at 12 to 13%. We had back-to-back recessions. Unemployment hit 11% by 1982, and people were waiting in 8-kilometer lines just to fill their gas tanks. And mortgage rates, they peaked near 18% in 1981. 18%! Imagine trying to buy a house at 18% interest. Now, what happened to housing during stagflation? This is the part that everyone forgets. Here's the key data point everyone misses. From 1970 to 1982, median home prices in America appreciated by 159%. Sounds great, right? Nominal prices nearly tripled, except CPI inflation also rose 159% over the same period. In real terms, adjusted for inflation, home prices went absolutely nowhere for an entire decade. Zero real appreciation. The purchasing power you put in was the purchasing power you got out. Robert Shiller's historical home price data confirms this. Nominal prices rose, but real value stagnated. Transaction volumes collapsed as rates made financing impossible. And the people who already owned homes, They just sat there, locked in place, because selling meant refinancing at crushing rate. The 1970s housing market didn't crash. Prices didn't crater 30% like 2008. There was no wave of foreclosures, no bank failures, but it didn't work for anyone either. Buyers couldn't afford to buy because mortgage rates made payments nearly impossible. Sellers couldn't sell because refinancing at new rates would destroy them financially. Builders couldn't build because construction costs were exploding and demand was frozen. The market just stopped for a decade. And when Volcker finally broke the inflationary cycle by jacking rates to 20% and triggering two brutal recessions in the early 1980s, the damage to an entire generation was already done. That's stagflation in housing. And the parallels today are uncomfortable. Let's look at the current macro picture because the data is troubling. Inflation is running at 2.9%, still above the Fed's 2% target. It's been above the target for 5 years now. It's proving sticky. Tariffs are adding upward pressure on goods prices. Services inflation is running at 3.6%. The Fed's preferred measure, core PCE, has been stubbornly elevated. The job market is softening. Unemployment has ticked up to 4.3%, its highest in 4 years. Job gains have slowed from an average of 250,000 monthly in 2023 to about 30,000 in mid 2025. But here's what's really concerning: long-term unemployment. People out of work for 27 weeks or more just hit 1.9 million. That's up 385,000 from a year ago. That's 25.7% of all unemployed people, the highest share since February 2022. Long-term unemployment is often a leading indicator that the labor market is cracking beneath the surface. GDP growth is weak. We're tracking around 1 to 1.4% for 2025. Not negative, not technically a recession, but not healthy either, just limping along. And the Fed is trapped. Jerome Powell calls it a low hire, low fire environment. Companies aren't expanding, but they're not laying off in mass either. It's a frozen labor market to match the frozen housing market. There's genuine disagreement inside the Fed about what to do next. Some governors want more rate cuts to support employment. Others are worried about reigniting inflation. The October FOMC vote wasn't unanimous. One member wanted bigger cuts, another wanted no cut at all. Harvard economist Jason Furman literally said the whiff of stagflation is getting stronger. The World Economic Forum published an analysis comparing today to the 1970s. EY's chief economist said stagflation isn't just a relic of the past, it is an ever-present risk. The pattern is there: sticky inflation above the target for 5 straight years, softening job market with rising long-term unemployment, weak GDP growth, central bank caught between competing mandates, housing markets frozen by rate locked in, rising costs across insurance, taxes, and essentials. That's the 1970s playbook, and we're running it again. Let me explain why this is such a trap for policymakers. The Fed has 2 mandates: price stability and maximum employment. Normally, these work together. When the economy is strong and employment is high, you raise rates up to prevent inflation and cool things down. When the economy is weak and unemployment is rising, you cut rates to stimulate activity. But in stagflation, these tools work against each other. If the Fed cuts rates aggressively to help housing and employment, they risk reigniting inflation. Money gets cheaper, demand increases, prices rise. We're back to 2022. If the Fed keeps rates elevated to fight inflation, housing stays frozen, business stop expanding, and unemployment risk rises. We tip into a recession. There's no clean exit. Every move has a cost. In the 1970s, the Fed oscillated back and forth for a decade. They'd raise rates, cause another recession, then panic and cut. Inflation would surge again. They'd raise rates, another recession. The stop and go policy made everything worse. It wasn't until Volcker came in and said, "I want to break inflation no matter what it costs," that the cycle ended. He raised rates to 20%, caused 2 back-to-back recessions. Unemployment hit 11%, but inflation finally died. The question for today: does anyone have the stomach for that in 2025? With an election cycle coming, with the debt at $38 trillion and rising, which means we're probably looking at a long period of stagflation. Not a crisis, not a resolution, just stagnation. So where does housing go from here? I'm not calling for a 2008 style crash. The fundamentals are different. We don't have the subprime exposure. We don't have the inventory glut. In fact, we have the opposite: severe undersupply after a decade of underbuilding. Builders have been 4 to 5 million units behind for nearly a decade now. There's no wave of forced selling coming. People with 3% mortgages aren't defaulting. They're sitting tight. Banks aren't over leveraged in the way that they were in 2007. The systematic risk isn't there. But I'm also not bullish on housing, not even close. What I see is stagnation. Maybe for years, maybe for a decade. Prices won't collapse because there's no inventory and no forced sellers, but prices won't appreciate meaningfully in real terms either because nobody can afford to buy at these levels. The demand is there. People want to buy, but the purchasing power isn't. We might see nominal price gains of 2 to 3% annually, but if inflation is running 2.5 to 3%, that's zero real appreciation, just like the 1970s. Transaction volumes will stay depressed. The lock-in effect will persist. Fannie Mae says 58% of their single-family loan carry rates below 4%. Those people aren't selling. Rates would have to fall to 5% or below to unlock meaningful inventory, and the Fed is projecting rates stay above 6% through at least 2026, maybe even longer. First-time homebuyers will continue to get squeezed out. The age of the first-time purchase will keep rising. 40 becomes 42, becomes 45. More people will rent longer. Some people will rent forever. The wealth gap between homeowners and renters will widen. The 43 to 1 net worth gap becomes 50 to 1. Becomes 60 to 1. The latter keeps getting pulled up. And insurance and property taxes will keep climbing. Even if your mortgage is fixed, your total housing cost isn't. A 3% mortgage doesn't help you when your insurance doubles. The 1970s gave us stagflation, a decade of frozen housing market, eroding purchasing power, and stagnant real returns on housing. The data says we're heading there again. Maybe we're already there. Prices nominally hold, real returns erode, transactions collapse, a generation gets locked out, and people who already own, they just sit there. The typical homeowner is now worth $430,000. The typical renter is now worth $10,000, and that gap is getting wider every year. That's the housing market at the end of 2025. And until something fundamentally changes, either a crash in prices, a crash in rates, or a massive increase in supply, or years of wage growth outpacing home prices. This is the new normal. The American dream isn't dead, but it's on life support, and nobody's coming to save it. So buckle up. If you enjoyed this video, I'm going to keep bringing you guys some hard truths filled with data and maybe some optimism here as I'm analyzing the market. So make sure you guys hit that like button and hit that subscribe button. And also check out one of these two great videos I've got for you right here. I'll catch you guys all at the next one.